This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, dollars and cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. This is Joel Garris of Nelson Financial Planning, and we've got a lot to talk about on the program this week. If you recall our program last week, golly, I hate being that accurate on what I think might happen. And lo and behold, it played out just as we thought it might this week in the markets. Boy, I'll tell you, if you were watching this thing on a daily basis, you needed to either be consuming a lot of eggnog or losing the television remote, because it was certainly one of those weeks that there was a tremendous amount of volatility. And if you recall what we were talking about on the program last week we were talking about the sort of the funkiness of the calendar, if you will. The holidays, Christmas, New Year's, falling on Tuesdays instead of closer to the weekend meant that the Monday was actually a business day, just as tomorrow is actually the last business day of the year 2018. So we don't quite have the exact numbers of where the market's going to close, obviously, for the year, because we still got one more day in it. But, of course, given that we're pretty close, then it's incumbent upon us at some point during the course of this program to not just recap the year that was, but also engage in our annual Fearless Forecast exercise. That exercise goes back at least 25 years when Jack was doing it by himself, and then starting about 20-odd years ago, Jack and I were doing it together. And I think I've got the numbers here up until the year 2011. Past that, then the Fearless Forecast became my sole bailiwick in 2012 when right after Jack retired from the business. So we've got a lot of that stuff to talk about here on the program indeed. So year in review, Fearless Forecast, and then, of course, this past week in the markets. We've also got open lines, so if you want to get in on the conversation, I've got a Christmas card from somebody about the Fearless Forecast, so we'll have to bring that into the mix as well. We talked a little bit about that on last week's radio program. And then, of course, we will also chat a little bit about the email the communication that we sent out to our clients this past week. But let's get back to that calendar and how odd it really was for this past week with the holiday falling on Tuesday. And we certainly hope your Christmas was good. Hard to, given all the market activity and sort of what we focus on a daily basis in the office, you kind of lose track that there was a nice holiday in there. So we hope your Christmas was good, and hope your New Year's, looking ahead to next week, is equally as good and enjoyable. Hopefully, it's an opportunity to spend some time with family and enjoy each other's company. But by falling on Tuesdays, the business day is still the Monday, and then, of course, you had 3 other business days last week and this coming week. And what we talked about on the program last week is that to really expect a bit more volatility than what you might otherwise have because of how that calendar works out, because the trading volume is going to be somewhat light. I actually read a statistic where 85% of the trading volume during this entire month of December has actually been more on program or computer-driven type of trading. So that helps to start to get to the explanation as to sort of what's been going on with these wild swings in the market, particularly this past week, because when you don't have human beings involved to stop and think, then the computers just go ahead and execute away. And so our concern last Sunday on the program was that we were going to see a lot of volatility. Little did I know just how much volatility we would see this week. The week started out pretty rough on Christmas Eve, which was a short day in the markets, I guess, thankfully, considering that was a pretty significant decline of over 700 points. The worst for the Dow, the worst Christmas Eve, obviously, ever. Wednesday, however, brought a totally different day, where it was a record day for the markets in terms of the point increase for that day, with almost an 1,100 point increase on the Dow. And then Thursday was another crazy day where the market was down 400 or 500 points and then wound up finishing up 300 points. So almost an 800 point intraday swing on Thursday. Friday didn't quite swing as much, but certainly some ups and downs. And the point of the conversation is, yes, there's a lot of volatility. It gets exacerbated when we have periods of time like this, where the trading is kind of thin, there's not much going on. So I'd continue to be wary of that for the coming week as well, because again, you have another odd calendar week where Monday is the business day, Tuesday is the holiday, so no one's really going to be paying attention tomorrow because most people have taken a 4-day weekend. And then you've got Wednesday, Thursday, Friday, and those days are probably going to be relatively light before people kind of get back into the full groove of the new year and everybody gets back to work, if you will. And so be careful of that also for next week as well, because with the lower volume, the programming and the computers can kind of take over and drive this thing a little bit more one way or the other. And I think that does get to a little bit of an explanation as to why the volatility has been so high, particularly this month of December, because when you look at these statistics that say 85% of the trading is happening through programmed or computer type trading, then that helps to give a little bit of an indication that a lot of this is short-term reactionary type of movement. Certainly the headlines out there have not gotten resolved, and we don't expect them to get resolved this coming week either, given the calendar. And, of course, this week with the change in Washington as well, I think the shutdown will continue. And obviously the Federal Reserve and the trade conversations with China are obviously going to be continuing as well. So from that perspective, I don't think any of these headlines will get resolved this week, but I do think over the course of the next few weeks, they will certainly get resolved. That thought lends us to some of the thoughts behind our fearless forecast for the year 2019, which we'll certainly get to later in the program. But want to really talk about kind of the communication that we sent out this past week to our clients about the notion of bull markets versus bear markets. You heard a lot about this conversation about bear markets. Technically, the NASDAQ entered into that territory on Monday of this past week. And first of all, what's a bear market? By definition, a bear market represents 20% decline in the markets, and so from kind of the peak number to the low number, anytime that percent decline moves above 20%, then it's often referred to as a bear market. And I could just see the glint in the media's eyes, because they love to trot out that word, because that helps to really stoke the fear component of this conversation. And so they were doing certainly a pretty good job of that leading up to this week, and certainly after Monday. And so we thought it incumbent to reach out to our clients and communicate with them. And so we thought it only appropriate to share sort of the gist of that communication with our listeners on the radio, because we sent out a chart that's actually an interesting chart that looks at bull markets versus bear markets. And the data goes back the past 70 years. Okay, so 70 years of data. Interestingly, as you might well expect, because there is a cycle part of the economy, there's been almost the same amount of, and there has been, bull markets versus bear markets over the course of the past 70 years. There's actually been 14 bull markets and 13 bear markets. And I guess if you count the most recent decline, then it would be even, 14 bull markets, 14 bear markets. But the statistics are available on, of course, the prior 13. And there's really some interesting numbers when you stop and think about it that really go completely counter to what everybody kind of thinks in their mind as what the statistics are when you start looking at market declines versus market increases. And when you start to actually look at the numbers and the charts, much like the chart that we sent out on this past Wednesday, which we're also going to have to put up on our website as well. I think we've converted that email over to a blog, but I don't know that we put up the attachment on the website at nelsonfinancialplanning.com. We'll have to do that. We'll have to do that this past week, so y'all can see the chart that we're looking at, because obviously radio does not exactly lend itself well to charts. But bottom line is that the stock market rises a lot and it falls a little, particularly when you look at it over time and over return. And we are going to get into those numbers in great detail, but we're going to take a break at this point, and we will shift to those commercials and then come back and give you some of these statistics on this bull market versus bear market conversation here on the program Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
iHeartRadio is the easy-to-use app for music and radio. Download the free iHeartRadio app today.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Yes, indeed. Feel free to give us a call at 407-916-5400. A lot of territory we're covering on the program today, for sure. We still got to tackle the year in review and, of course, our fearless forecast, our little tongue-in-cheek exercise. We'll tell you how we did this past year with our fearless forecast and kind of recap some of the numbers from years past. Before we get to that, of course, we're talking a little bit about the conversation that came up a lot this past week in terms of bear markets, declines of over 20%, really made a lot of headlines technically because one of the three major indexes sort of crested that threshold, and so consequently the media love it when that happens because it gives them an opportunity to scare people. The problem is that it's only a portion of the story, and the chart we sent out to our clients on Wednesday that we're going to make sure and post this week on the website tells a very different story. Tells a story of the fact that if you look at the past 70 years, there have been periods of time when the market has gone down and periods of time when the market has gone up. And interestingly, the market goes up a whole lot more than, in fact, it goes down pretty dramatically, as a matter of fact, when you start to actually look at the numbers on the average length of time of your typical bull market, which is obviously a market going up, versus a bear market. So as the statistics are over the past 70 years, there's been 14 bull markets and 13 bear markets. The percent of the time that a bull market occurs in an economic expansion, that's 85% of the time. The percent of time that a bear market occurs in an economic expansion, well, that's 16% of the time. And that should start to make some sense, right? If the economy is expanding, generally the market is going up. But what's interesting is it's about tied as to the occurrence of a bull market and a bear market during a recession. 48% of the time, bull market, bears have it a little bit at 52%. Here's the more important statistics as we get into these numbers. The average length of time for a bull market, looking at history over the past 70 years, is 46 months. Average length of time of a bear market is 13 months. Don't let anybody tell you differently, that somehow bear markets last longer and are a much greater occurrence. The statistics over the past 70 years clearly says otherwise. The average annual return during a bull market is over 23%. The average annual decline in a bear market is down 23%. So pretty close numbers on that if you look sort of at the average annual numbers. But here's the more important number that really underlies why our approach in terms of staying invested through good times and bad, because you cannot predict it. And we've got another statistic we'll talk a little bit here about, is the average cumulative return. The average cumulative return in a bull market, 125.3%. In a bear market, the average cumulative return is a decline of 25.8%, looking at the past 27 bull bear markets over the course of the past 70 years. Let me say those numbers again. Which one do you want? Well, obviously you want only the bulls, but you can't really separate the bulls from the bears. The bull markets, cumulatively 125.3%, bear markets down 25.8%. Let me help you with the math. If you're up 125.3%, you more than recover from a bear market whose average decline is 25.8%. So keep those numbers in mind, particularly in light of the conversation that you're going to hear on a continual basis in the mainstream media. One other important statistic that we shared with our clients this past week is this notion, and you've heard us say this before, the notion of staying invested through good times and bad, not just because of those numbers that we gave you on the percentage returns during bull markets versus bear markets, but also the notion that volatility has two sides of the equation, right? We saw that play out this past week. Monday, a dramatically down day. Wednesday, dramatically up day. Thursday started as a dramatically down day, ended up as a dramatically up day. That's volatility, both bad and good. And again, you miss any of those days. See, the likelihood of you missing Wednesday, for example, this past week is quite high, right? Because you see what's going on the day before Christmas and you say, my goodness, I can't handle this. I'm getting too fixated, and I have no ability to see past today because the media is telling me that tomorrow and every day after that is just going to be a train wreck. And so you wind up making a move that gets you to the sidelines. And certainly when you look at the numbers this month, and here's the statistic, this month you had the largest exodus, and the month isn't even over, the largest exodus from stock mutual funds in a single month ever in recorded history. the largest exodus from stock mutual funds in a single month ever. Total of, at last count, over $75 billion was moved from mutual funds and ETF in the month of December. That's money that's going to sit. That's money that's going to sit and it's going to wait. And the only way it gets back into the market is much higher than where it is now. The problem is that means that those folks are all going to miss the steepest part of that increase, which is always that turn around point. And certainly when you look at those kinds of numbers and everybody running to the sidelines, my goodness, that is a fundamental undermining of investment results over time. Here's how dramatic it is. If you had stayed fully invested over the course of the past 15 years versus if you missed just the 10 best days, and I think Wednesday of this past week will probably be one of those 10 best days if we look back 10 years from now or 15 years from now. The reality is that your return winds up getting cut in half. Now, you may say, well, how is that possible that the return is that concentrated? Well, that's the part of volatility. Volatility, remember, has both two sides of the equation, the down and the up. But if you look at the numbers, an investor who had stayed fully invested had a return over the course of the past 15 years of close to 10%. Meanwhile, if they missed just the 10 best days, their return was just 5%. These are dramatic numbers that really underscore 10 days out of 15 years. Stop and think about that for just a second. That's 10 days out of 15 years of trading. That's tremendous. And all you got to do is be wrong just a few times, and you'll see your return get cut in half. You want to take that risk? Well, apparently, there's a lot of people out there that do, given the $75 billion that came out of stock mutual funds and ETFs during the course of this past month. I wish them well. I think that's a major mistake from an investing perspective, and certainly the numbers would bear that, no question at all, when you start to kind of look at the relative numbers and the percentage numbers. So that's the conversation of this past week, and of course some perspective on bull markets versus bear markets and how that has played out, in fact, over the course of the past 70-odd years, looking at all of those various bull and bear markets. We're going to slide now to a break here at the bottom of the hour. When we get back, we will, of course, talk a little bit about the year that was 2018, almost in the books. We got one more day, but certainly the headlines and the economic numbers are pretty well known. So we will recap those here on the program here on Dollars and Cents when we get back from these messages on 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen, Dollars and Cents. This is Joel Garris of Nelson Financial Planning, our last show of the year 2018. Hard to believe that, my goodness. When you look at the headlines, it was certainly just like any other year, right? I mean, all over the map, if you will. What's fascinating about this year, as we think about the year 2018 and look ahead to 2019, is that the year 2018 will actually go down as one of the best years in terms of economic data, perhaps by some measures, one of the best years economically in decades. And so it's kind of interesting that the year ended on such a sour note, particularly in this last quarter from a investment and market perspective, because when you take a step back and look at the economic data and even the stuff that's just coming out right now in terms of holiday shopping was 5% better than it was a year ago. That's one of the strongest retail sales numbers in several years for the holidays. The unemployment rate, which for last month in November stood at 3.7%. That's a 49-year low in terms of the unemployment rate. The economy growing at 3%. That is a rate of growth at 3% that was only topped in this current economic expansion, which would go back to March of 2009. That was only topped in only 3 other quarters during that period of time since March of 2009. And of course, inflation being at close to the Federal Reserve's target of that 2%. Seems to be hanging in there pretty decently. And if you look further at the data, many of the groups of folks or the groups of Americans that have typically been left behind, if you will, in other economic expansions have actually seen some decent improvement in terms of the numbers. The unemployment rate for Black Americans, for example, at 5.9% in November, is the lowest that it has been on record back to 1972 for high school dropouts. The unemployment rate hit a low of 5.1% for that group of Americans this past summer, and that's the lowest it has ever been in the course of measuring that number. So, when you kind of look at the data, it's fascinating to see just how decent the data has been from an economic perspective. And then, of course, if you look at, sort of the policies that came out of Washington, particularly earlier this year, involving lower taxes, right? Which we as individuals really haven't seen much on our tax returns. We're about ready to see them once we start to prepare our 2018 tax return. But certainly a lot of businesses saw them. And so certainly you had a bit of an uptick in terms of the economic numbers as a result of the big tax changes that happen when you look at income tax rates getting cut and then the consumer spending increasing dramatically and corporate tax rates going down. All of that from a pure economic perspective will have the year go down economically as, in fact, a pretty decent year. Of course, as with any year, there's a litany of headlines that always make you pause for some concern. I think socially the country remains as deeply divided as ever, and you certainly have a tremendous amount of headlines out there from the conversation about the yield curve and interest rates to trade and China, and of course that whole conversation. Those two issues are really dominating the headlines now, interest rates and the trade. And then, of course, now we're in the midst of a government shutdown. But if we take a step back and look at some of the other headlines that happened during the year 2018, you'll see the Brexit was a main headline during the course of 2018. Similarly, the change of policy, or I guess the change of relationship. I guess I'm not sure where the relationship is now, but if you look at North Korea was also a major headline. The European Central Bank and what their moves are, major headline. You had Brett Kavanaugh in terms of that nasty Supreme Court confirmation. Tremendous amount of headlines over the course of the past year, which at the end of the day really are no different than any other year, right? I mean, there's always a litany of headlines that serves to dominate each and every year. And at the end of the day, somehow, some way, the markets, the economy, and the rest of us all sort of move forward. But interesting to see the strength of the economic numbers, which really does help to sort of lay the groundwork for our fearless forecast, if you will. And technically, we can't technically do it because we don't know where the market is going to close tomorrow. Because with all this volatility, who knows where the numbers come in? But we're going to give it a shot anyway, because we know where the market closed on Friday. The Dow closed just a little above 23,000 at 23,062 with a fractional 40 on that. So 23,062 was basically the Friday close of this past week. And so from that perspective, as we look ahead to 2019, a lot of these economic numbers are going to play a major role in exactly how that year is going to play out. Well, speaking of the fearless forecast, I guess we need to turn our full attention to that. And first of all, we were off, if you will, this past year. We were on track 3 months ago. We had predicted for the year 2018 roughly a 10% increase for the markets at 27,300 was our prediction for where the markets were going to end in 2018. Longtime clients and friends, Leanne and Rick, sent me a Christmas card, a very nice, handmade Christmas card with their predictions. They were a little bit north of me. Leanne was at 29,000. Rick was at 30,000. I was not quite that optimistic. But my prediction of 27,300, obviously, to close the year, we are a bit off by that, to say the least, about 15% off. If you're curious about our track record in prior years, I've got the numbers going back the past 7 or 8 years. And as you might well expect, it's a bit of a mixed bag. Some years we're on it, some years we're not. This year is one of those years where we are most definitely not. Although, in our defense, we were certainly on track 3 months ago when the Dow on October the 3rd was at 26,828. That was sort of the peak for the year. That would have been very close to our 27,300 number, but unfortunately, obviously, it did not stay there. And so consequently, when we look at these numbers, what goes into our thought process for next year and where we see the markets finishing out for the year 2019. Well, to get into that, we're going to share with you some of the data that we see out there, some of our thoughts in terms of how this might all play out. And so we will get into all of that once we slide to our next break, and then come back and sort of lay the foundation for what our fearless forecast is going to be for the year 2019. So stay tuned through the break, and we will come back to that, our annual exercise, if you will, of our fearless forecast for the markets. A little tongue-in-cheek, if you will, on it, in all honesty and candor, because, of course, nobody can what the future is and what the markets are going to be. But this time of year, everybody likes to do that and see how they come out. So we will do that, and we will recap where we are looking ahead to 2019 when we get back here on the program. This is Dollars and Cents with Joel Garris, Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. The last segment of the program of our last program for the year 2018. Hard to believe that year rolled on by. We recapped some of the big headlines that floated across the newspaper this past year. And so this segment of the program will sort of look forward and talk a little bit about what we see in 2019. And then, of course, roll that on into our fearless forecast for the year 2019. That's a little bit of a tongue-in-cheek exercise that started 25 plus years ago by my father-in-law, Jack Nelson, and then we did it together for a number of years there, and then for the past several years, it's just been sort of mine. Our record on it is, some years good, some years not good. 2014, we almost nailed it right on. 2016 as well. 2017, we undershot it. 2018, we overshot it, obviously. Our prediction for the Dow this year came in at 27,300, and it looks like the market's going to close around 23,000. Of course, depending upon how tomorrow goes, that could move quite a bit given the most recent volatility, but looks like we're certainly going to be off. So that certainly starts to form our foundation for what we think 2019 will be. You know, one of the things that I think continually gets forgotten, as we were talking a little bit about in the last segment, this year economically is actually going to go down as one of the strongest of the current expansions that's been going on since early 2009. And the thing about this expansion sort of post-2008 is that it really has been characterized by one of the slowest average economic growth rates in U.S. history. And that may sound like a negative, and there is a part of that is certainly negative. We always would like our economic growth to be much higher. But the good side of that, or the flip side of that, is that because the economic expansion and growth rate has been so slow, it really has, when you start to look around, generally prevented any major imbalances from materializing. And if you look at typically recessions or particularly tough economic periods of time, usually there is some type of imbalance that has happened that ultimately sort of needs to get corrected. Obviously, 2008, 2009, it was the housing market and the loose lending policies that existed, which led to a tremendous imbalance from an economic perspective. If you look further back to, say, the year 2000, it was obviously the dot-com, the technology that was really driving things much more dramatically and overdriving things, if you will, from an economic perspective. So what's interesting about this cycle, as we were saying in the last segment, this year is probably going to go down as one of the best in terms of the economic data for this particular expansion. The overall expansion has been relatively muted. And as you kind of look through all of these headlines that are out there, as we look ahead to 2019, certainly the issues that are weighing on the market, the trade, the interest rates, and of course now the government shutdown, what do we see as perhaps the most important issue that could affect our economy and the global economy? And I think out of all of those, I think the Federal Reserve is probably going to dial it back a little bit more. I mean, they're very cognizant of what's going on in the markets. I think the trade dispute with China will ultimately see some form of resolution. Certainly the government shutdown, I think, will start to see some form of a resolution in the weeks ahead as well. And that should serve as the basis of a recovery from the damage that was done, particularly during the fourth quarter of this year, 2018. The single biggest issue in our minds, and certainly these other issues, particularly interest rates and the China trade conversation, are issues to watch for sure, because if they do not resolve themselves, then obviously that's going to create a significant economic ripple. But the single biggest issue, we think, is going to be China, and not just the trade conversation with China, but rather the economic equation in China. Their economy is very much slowing down from double-digit growth rates that they've been reporting for many years, for over the course of the past 3 decades, to a rate that is sort of mid-single digits. And the question really is, what's the impact of that going to have on the global economy? And that does certainly tie in a little bit to to this conversation of this trade policy and the need for China really to get a solution on this at a much more faster clip than we hear in the U.S., because their economy is in a much more fragile state. So this trade conversation is somewhat intertwined, but the reality is that the Chinese economy, as the second biggest economy, is certainly kind of the one to watch. And certainly the numbers out of China suggest that they are, in fact, slowing at a much bigger clip, if you will, than certainly ours, for example, in terms of the economic numbers coming out of China. Another thing to think about, and this sort of also relates to the government shutdown as we look ahead to the year 2019, is that, of course, it is a year following a midterm election year. And the markets have a phenomenal capacity to sort of ignore the political noise, particularly when you've got gridlock. I think obviously this coming year you'll see a lot more gridlock. The interesting statistic on the year following a midterm election year is that in every one of those since 1950 has actually been a positive number or a positive number for the markets as a whole. So some interesting numbers as it relates to midterms. Similar numbers on the third year of a presidential cycle as well, that really gives us hope for the next few months, weeks and months, and particularly with respect to what we expect for 2019. Certainly, there are some unbelievable trends out there that I think are going to be major drivers of the economy. And we'll give you a sort of a taste of 3 of them. We'll probably talk a little bit more about this next week on the program. But when you look at opportunities out there in terms of technology, and when we talk about technology, particularly relating to cloud computing and what that looks like, and basically that is, using massive servers to share data. Certainly on the biopharmaceutical side of things, I mean, it's incredible to see the advances in cancer treatment and what that looks like. Air travel is another one that I think will have a tremendous amount of ripple effect overall in the global economy. Last year in Asia, there was 100 million people that took their first airplane flight. I mean, the numbers are really kind of staggering when you start to take a look at some of the economic trends that I think will drive 2019. We're going to talk a lot more about those economic trends next week on the program. But I think a lot of those economic trends really do help to serve the basis of our fearless forecast. So without further ado, particularly since we're running out of time in the program, we'll give you our number for where we expect the markets to be for 2019. We expect them to fully recover what went on and what went on in the fourth quarter, so that to repair that damage of that 15% decline that happened in the course of the fourth quarter. And then also to be able to add a little bit more, we'll say 4%. That's a conservative number. So the recovery of the markets from the damage in the fourth quarter plus 4% would put you at a Dow of about 28,400. So that's our call for this year, our fearless forecast for 2019. y'all who like to keep score on this stuff at home, and we know that there's a number of you who like to do that. Put that in pen. 28,400 is our fearless forecast for the year 2019. So we'll see how close we come. Unfortunately, this past year we were well over that, but the year before we were well under that. 2 prior years we were right on. So we'll see. We'll see how that number plays out. But certainly at 28,400, that's our call for the Dow. That is based upon recovering from the damage in the fourth quarter and getting back on track with a modest growth rate on top of that. So stay tuned for that. We're going to flesh out more of that fearless forecast next week on the program, particularly getting into these economic trends that we think will be major drivers for the year 2019. So we'll look forward to talking more with you all next week on the program about that. Thank you all for listening. Hope 2019 turns out to be a great year for you all, and we will wrap it up on this end. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA.
This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.